Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone senior market strategist Michael Brown. And this week we've seen equities come off the back of 8 days of gains for the FTSE 100, and while a lot of people have suggested that perhaps this is a dead cat bounce, Michael, I would suggest it's a pretty bouncy cat.
Yeah, very good afternoon to you, mate. Good afternoon to our listeners as well. It has been quite a positive week in terms of risk appetite, actually. I think the market is taking a little bit of solace in what appears to be a somewhat softer tone from the United States towards China when it comes to trade. That hasn't necessarily been reciprocated from the other side, but as you say, it's a very, very bouncy dead cat, and risk appetite has been given a little bit of a shot in the arm in what, of course, is still a holiday-shortened week, at least here in Europe.
Yeah, I mean, elsewhere, US and European equities slightly more resilient. Optimism, as you said, is building that President Trump has realised that while you might be able to bully fellow politicians, the market is a completely different beast and really doesn't take well to being bullied. And I think he's also stepped back from his sort of browbeating Fed Chair Jerome Powell. I think that's also, helped the more buoyant tone.
Yes, I would agree with that. He has pulled back on his idea of terminating Powell early. But speaking of that, we better get the risk warning out of the way, otherwise I'm in danger of getting terminated over here, I think.
Yeah, we can't have that, mate.
No, we can't. I assure you of that.
Though having seen your puns about Pony AI, perhaps I would suggest that you probably could do with being put down. Anyway.
That's a bit harsh.
Anyway, I jest, of course, mate. I jest, of course. Regular social media followers of you and me will know that we rip each other quite aggressively when it comes to our respective punnery.
Indeed.
We've even got John Stepek at Bloomberg involved now, so it's almost like a three-way split when it comes to see who can post the worst puns. Anyway, digressing aside, let's get the risk warning out of the way. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex financial instruments and come with a high degree of risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so we've got a lot to get through. Well, we've had a fairly busy week when it comes to earnings this week. Obviously, we've heard from Netflix on last Friday.
Yes.
We've heard from Unilever and Reckitt Benkiser this week. We've heard from Tesla this week, and we're hearing from Alphabet, Google, later tonight. So obviously we don't have visibility of them. So we're going to talk about that a little bit. And then essentially what we're going to do is look ahead to what is a very, very busy week next week. And before I forget, we can also go through Boeing's numbers as well, given the discussion that we had last week about Boeing. Next week, a macro aside, we've got non-farm payrolls, and I really think that's the only real data, economic data of note. Really, I think the big story next week, it's about UK banks, all the big four. They're reporting their first quarter numbers next week. We've got BP and Shell also reporting, so those are pretty interesting ones. We've also got AstraZeneca's first quarter numbers, another one of the big hitters in the FTSE 100, and we've also got big tech, continuing the theme from obviously Alphabet. Later this week we've got Meta Platforms, Microsoft, Apple and Amazon. So a lot to get through. I mean, I've written one page alone on UK banks.
I was going to say, the other thing we've got a lot of is paperwork. I've got half a rainforest in front of me here in terms of everything that's going to happen over the next week or so.
Yeah. And for our TikTok fan club, we've got Travis Perkins' first quarter numbers. And those of you who may recall, they delayed their full year numbers, and the markets didn't really take too kindly to that. So we've got a lot to get through. Let's make a start with Netflix, because you may recall that a couple of weeks ago, whatever it was, I was saying that Netflix shares have proved to be pretty much tariff proof when they came to the effects of how the markets had reacted pretty much across the board with the Magnificent Seven. People talk about the Magnificent Seven as if it's a homogenous block. Netflix, is it really part of the Magnificent Seven? It used to be. It is a FANG stock. It's the old FANG stock.
Yes, if you think back to that.
And if you want to go back that far, But, the numbers were pretty decent.
Yeah, they were. I mean, there wasn't really too much to complain about with regards to the earnings. Yeah, actually, I think, earnings season so far, obviously we'll get on to Tesla momentarily, which was pretty disastrous. But by and large, I mean, there have been in terms of reporting season, there has been a lot of negative guidance and various scenarios being outlined in guidance. But I would argue that on the whole, earnings season hasn't been necessarily as bad as everyone had feared. But then it's probably too early for earnings to have turned south, given the timings around tariffs and everything else that sort of started at the beginning of April, so after the end of that first quarter.
Interesting. I'm just looking at my chart here. Netflix shares today are on the cusp. Well, actually, they are hitting new record highs. Well, so, what does that tell you? When you actually look at the Q1 trading update, headline numbers all came in ahead of forecasts. Net income surged to $2.89 billion, well ahead of the $2.4 billion that was in their previous guidance. And there was a big leap in operating margin to 31.7%, well above the forecast. Q1 revenue, 10.5. Company upgraded its forecast for Q2. And obviously that's the quarter that I think an awful lot of people are interested in, given the increase in the cost of living. That's the one to watch. But they were pretty upbeat about that, talking to Q2 revenue of just over $11 billion. So net income for Q2 is also forecast to rise to just over $3 billion. So they're spending a lot of content, but they're also making a lot of money. You sort of look back to about 4 or 5 years ago, and people were really concerned, and I was vocal about saying it. How can they spend all this money on content as well as increasing their revenue in what is a very, very cutthroat market? You've got Disney, you've got Amazon Prime, you've got the ITVX, you've got more Channel 4.
Congested market, isn't it?
Absolutely. Yet Netflix continue to lead the way.
Yeah, absolutely. I mean, there really is nothing to complain about in those results whatsoever. And as you alluded to earlier on, they could potentially be sort of insulated from the trade war, insulated from tariffs. We talk about all these levies that are being imposed. They're all on goods. They're not on services. So someone like Netflix, you would expect should get away relatively scot-free on that front. The issue, of course, with streaming more broadly is the competition within the sector. But thus far, Netflix, as you rightly alluded to, they're spending a hell of a lot on content, but they are getting the rewards for that investment. As long as that continues, then there's no reason why the stock shouldn't continue to perform.
Yeah, I mean, solid growth in all its regions. The weakest growth, notably, was in the US and Canada. Obviously, that's probably one of the most competitive markets. But even there, revenue slowed to 9% from 17% a year ago. For me, because I think they do an awful lot of foreign language films, and not an awful lot of other streamers do that. So I think in terms of that, they've got a really good first mover advantage there. The bigger question is whether they can sustain it. But looking at the chart, the momentum clearly is to the upside. Okay, so let's move on. Tesla, a bit of a car crash. Yes, I'm going to say it.
God. Well,
but someone didn't tell the share price. Someone didn't tell the share price.
Exactly. The earnings were just horrible. They were absolutely horrible. I think they they certainly missed on top and bottom line revenues and profits. I think they pretty much missed on every other metric that there was a consensus for as well, whether that be margins, whether that be cash flow, whatever. But the shares were up about 8 or 9% in the aftermarket session after the earnings were released. And I think, again, we're pretty sure we discussed this last week where we were talking about what investors are looking for with Tesla. Is when is Elon Musk coming back? And according to what he said on the earnings call, he will be stepping away from the Department of Government Efficiency, DOGE, from the middle of next month. And I think that is really what has given a boost to the share price, coupled with the seemingly ever-present mention of robo-taxis coming soon, which the Tesla fan club seem to like, but never actually end up getting delivered. You put those two things together and, Tesla stock has certainly charged up.
I'm going to ignore that, pun aside. What did Tesla earnings really tell us that we didn't already know? And I think this is really the key question for me, because yes, we've seen a bit of a rebound. We've seen a rebound off the March lows. We haven't really pushed back above the March highs. Yes, we've seen a fairly decent rebound, but I'm looking at the numbers. Okay, the brakes came on automotive revenues. They fell 20%. Sorry about that, to $13.96 billion. And then it's down from 17.3 the year before. Truth be told, we already knew that revenues would be down because of the 13% fall in deliveries that we knew about from earlier in the month. So we also know that the reason the deliveries were slow or lower than they were was because of the shutdowns in the factories, which were caused by retooling for the new Model Y. So again, not really too much of a surprise. So yeah, there has been a backlash. We've seen that in the sales numbers in Europe, 50% fall in European sales, but UK sales are up 21%.
Yeah.
So, there is obviously a must factor involved, but will that continue? And I think for me, one of the things I did take away from the fact was that in energy storage and solutions, there was a 67% increase in energy generation and storage revenue, the 2.73 billion, and a 15% increase in services revenues. So Powerwalls and chargers continue to improve their percentage in terms of the overall earnings. So automotive revenues were always going to fall or slow because you've got legacy car makers improving their offering. Obviously, you've got BYD out of China, who's making a cheaper model. So for me, I think the Musk effect is a factor. It's not the only one.
No, I think it's a good point around, did we learn anything new? Probably not. And also you look at Tesla, we were down, 40 odd % on the year going in to that earnings number. So you would argue that actually a lot of that bad news has probably been priced in and discounted already. The one line in their report that I did think was interesting, though, was that they removed reference to the company returning to growth this year, which they had guided towards in the prior quarter. So yes, the earnings are bad. Yes, there are some sort of silver linings within there, but overall, that return to growth for the company is likely to be delayed compared to where it was previously. So that's something worth bearing in mind as well.
But it's interesting to note that Musk did say that tariffs would potentially have a negative effect on the earnings outlook, and how could they not?
Well,
given the
exactly.
fact that China is probably one of Tesla's biggest markets, and they've got a gigafactory over there. So I just think that that's the way. Tesla would have had all of these problems whether or not Musk was in Trump's government or not. So really it's just a question of putting that to one side and saying, has the share price fallen enough? And if it has, is now a good time to buy? I would argue that at the moment we're in a little bit of no man's land between 290 and 220, and we get a break either side of that and we'll get a better idea of the long-term direction going forward. So I think that for me, I want to try and strip away the hyperbole when it comes to Musk's involvement with Trump. I think it's a distraction to the wider concerns that Tesla is facing, not only in its automotive market, but also in energy generation and storage, because ultimately it's not now just a car company, despite what Peter Navarro would have you believe.
Yeah, and I think that is overlooked quite often, isn't it? They do other things other than just make vehicles.
Yeah, and it's becoming a much greater proportion of their overall revenue.
Yeah.
So let's move on to Boeing. Another loss, but investors appear to like what they had to say. Decent rebound, revenue of $19.5 billion, an increase of 18%, and management do appear to be seeking FAA approval to increase the monthly production numbers for 737 MAX 8. But it goes to your point that you made last week about Airbus. Their production numbers are almost double. So they've still got a long way to go. I think the $10.6 billion sale of its navigation business has probably helped the share price here as well, because that's a nice, decent cash inflow, I think, for a company that really needs it.
Yeah, I would agree with that. And the other thing with Boeing is that their margins were positive again, which I think was something that investors look favourably upon. And as you say, I think not only is the sale of the navigation business an injection of cash, it's also potentially a sort of nod from the company towards sort of refocusing on their core business, as opposed to all these various other sort of ancillaries that they've picked up and developed into over time. And given the very well documented and well discussed, certainly on this podcast, issues that Boeing have been having in recent years, I think that is providing a degree of reassurance as well. But, the way you view the results depends on what you look at them relative to. If you look at it relative to how Boeing have performed in the last year or so, you'd say, actually, this is all right. If you look at it, as you alluded to, relative to Airbus, their closest and maybe only competitor, certainly in the commercial space, you'd go, you're still a long way off the mark.
And I would say it's the latter. It's still a long way back. As I said last week with that saying, if it's Boeing, I'm not going. They need to change. They need to change that mindset from what it was in the 80s, when it was completely the reverse of that. So,
And it's going to take a very, very long time to change that mindset now that it's become embedded.
Absolutely. The bad publicity of the last 5 years will stick around for a very, very long time. And they'll have to work very hard to regain people's confidence. And part of that, I think, is in the defence sector, where Donald Trump appears to have forgiven them to a certain extent for the delay of the 2 new Air Force Ones by granting them a new contract for the new F-47 next generation fighter jet.
Yes.
Which he gave to them over Lockheed Martin, who produced the F-45. So let's hope they deliver that on time, unlike the new Air Force Ones. Otherwise, we could be going full circle on this maybe in a few years' time.
Yes, indeed. The other, one thing I did think was interesting in terms of that contract actually was, and I'm not an American lawyer, so do forgive me on this one, but there is some sort of mechanism whereby these sort of federal contract awards can be challenged by other people that were effectively pitching for the same deal. And I thought it was interesting that Lockheed Martin came out and basically went, no, we're not going to do anything whatsoever. They also reported earnings this week, which weren't particularly pretty, I don't think. But the reason I think it's important or interesting that they came out and said, off you go, we're not going to challenge it, is probably because they're looking after themselves and going, we don't really want to run the risk of winding up the president and potentially not just missing out on this order, but missing out on future orders for things like the new Navy fighter jet that they're going to be pitching for later this year.
Or maybe it's just a simple case that they didn't like the commercials. Let's face it.
It could well be that as well.
But Boeing have been screwed a little bit by the commercials on the new Air Force One jets. They pitched it at a price that they knew they probably wouldn't be able to deliver it.
Well, it's also fixed price as well. That's the problem that Boeing can't do. They just keep taking write-downs on it every quarter.
Yeah, and that's not a good business model. Okay, so we got Reckitt Benkiser and Unilever, both numbers fairly decent, nothing really to write home about. I think one of the things I did take away from the Unilever results is we got a timetable for the hiving off of the ice cream business. It's going to happen on July the 1st. It's going to be called the Magnum Ice Cream Company, and it will start operating on a standalone basis on the 1st of July. The plan is to list in Amsterdam, UK, and the US with the HQ in Amsterdam. So obviously the primary listing in Amsterdam. I mean, why would you not want the Magnum UK Ice Cream Company or the Magnum Ice Cream Company listed as a primary listing in the UK? You would, wouldn't you? But we've missed out on that. Well, yeah.
But if you're sat there in the investor relations department, I can completely understand why you wouldn't be listing here, to be honest.
Well, so can I. But as I say, underlying sales growth, 3% gain, led by personal healthcare, 5.1%, beauty and wellbeing up 4.1%. Share price, don't think people really care that much.
I was going to say, it's one of those where you're sort of tapping your screen going, is this thing on? It hardly moves.
Exactly. And Reckitt Benkiser, disappointing numbers. There was a jump in core Reckitt, like-for-like net revenue 3.1%. But the main drags, Essential Home, down 9.7% in revenue. They're selling that anyway. So that would suggest to me they've really lost interest. And a 1.7% decline in Mead Johnson meant that total net revenue slipped to £3.68 billion, a decline of 1.4%. I think that Mead Johnson has to be the worst deal ever when it comes to the value add that it's offered Reckitt Benkiser, because it's been nothing but a pain in the A for them. You lost money, and I can't help thinking that at some point, given the fact that it's not part of core Reckitt, they'll look to sell that too.
Yeah, that's a very good point. I mean, just going back to the sale of the Essential Home unit, I agree. It does, you kind of look at it and you go, well, they don't really care about that anymore. And arguably, why would they? They're getting rid of it. The only problem is if you look at deal-making activity and just sort of general market conditions, they're not particularly inducive to any sort of spin-offs or M&A or any sort of corporate actions at the moment. So you kind of wonder, fine, they might have lost interest in it, but are they going to be stuck with the thing for longer than they might have expected? And is that going to act as a drag for longer than investors would want to see?
Saying that, Magnum ice cream might be worth looking at in Q4. Yeah. So, I think Unilever obviously feel that they're going to get a good price for it. When you actually look at the underlying business, the ice cream business did all right in the last quarter, and we're heading into summer. I think the only concern I have about that is the activism of a certain part of the management there in terms of Ben & Jerry's. That can make it very much Marmite when it comes to looking to buy Ben & Jerry's products. Now, when I go out to a shop, I don't want to think about the political views of the company of whose ice cream I'm eating. I just want to enjoy the ice cream
because it's quite nice.
Yeah, exactly. Stay out of politics. I'm not interested in what you think about the topics of the day. Do what you do best, and as for the rest of it, just shut the hell up.
Well, and actually, to be honest, that in my mind that goes not just for Ben and Jerry's, but for every company.
Well, anybody else, yeah, exactly.
All of this stakeholder activism and all the rest of it, absolute nonsense. Just stick to what you know. Basically, if you're there to sell ice cream, go and sell ice cream. Don't try and be some sort of social justice warrior. But
no,
anyway, I'll get off my soapbox now.
Don't worry, mate. You and me both. Okay, so we're going to move on to the big ticket items now for the week, for next week. Obviously, the macro data, non-farm payrolls. Don't really care that much about non-farm payrolls. We're not really seeing that much in the way of the US job market to suggest
we will
that
care
the US
if it rolls over.
Well, we will, but the weekly jobless claims today, 222,000. Fairly decent. Continuing claims, 1.8 million. There doesn't appear to be any softness in the US labour market at the moment. Unemployment's at 4.2%. It did edge up last month, but that was largely as a result of a rise in the participation rate. So it doesn't tell us more people coming in, more people looking for work, which suggests that people are optimistic about finding a new job.
Yeah.
So that sort of... that pushes up against some of the, other data that suggests that consumer confidence is collapsing and the US economy is struggling. I mean, durable goods today was a really decent number. I mean, I would imagine there was a big item in that.
Huge skew in that. Just on that, durable goods rose, what was it?
9.2%
or something. Transport was up 27%. Non-defense aircraft was up 140%.
So big ticket
that's
items.
why we had that big skew in the data there. But yeah, the US labour market's a bit of a weird one because, as you say, all of the sort of sentiment surveys are rolling over quite considerably, whether it be business or consumer. But for the time being, at least, the labour market seems to be sort of holding up okay. And, there are a lot of competing forces there. I think one of the things we might be seeing is this potential idea of firms sort of hoarding labour, knowing that it's very, very difficult to hire. So effectively going, yes, there are uncertainties on the outlook. Yes, we're going to have to deal with tariffs and whatever else may be thrown our way. But we would rather keep people in employment and continue to hire if we need to, and wait and see what the impact of that actually is when it arrives, rather than, let's say, preemptively shrinking the size of the workforce and then being in a bit of a bind where you go, well, now we've got all of these vacancies, things aren't as bad as we expected, and we can't fill them. So I think that might be something to bear in mind. But there are, on the flip side of that, headwinds as well. I mean, a big one, Intel, they announced 20% of their workforce that they're looking to lay off this week. So it's not all fine and dandy, but it's not as bad as we have been expecting.
Were those job losses US based or globally?
I think that's 20% global.
Right. Okay. So you could argue that it may hit the US, but I would argue that if it's Intel, they'll be reluctant to cut US jobs at a time when a US president is banging the drum for improving the US industrial base. So I would suggest perhaps a lot of those job losses may happen overseas.
Potentially. We will see. They report actually tonight, so we might get a bit more clarity on that.
Okay. Well, that'd be an interesting one to keep an eye out for. Okay. So next week we've got a big docket. We've got a big docket for earnings. We talked about it in the introduction. I'm going to start with BP and Shell. Now, I think BP and Shell, they've had divergent fortunes over the course of the past few years. I think you can question the competence of BP management. I think they got the memo very, very late about moving away from renewables. The CEO of Shell, Sarwan, got that memo in 2022 and decided to focus on essentially the businesses that made them money over basically burnishing their green credentials. And now we've got Elliott Management pushing BP management into a similar story. But when I look at the BP share price, we hit a 3-year low only this month. And there's very little sign at the moment of a significant turnaround. And I think perhaps the chairman's leaving, Helge Lund. I think they want him to go straight away. He wants to hang around until next year. I don't think that's viable in any way, shape or form. And if I'm honest, I think the CEO needs to go as well, because he should have reversed course a year ago. And think there's been some chatter that they could be a takeover target. What's your view on that? I must admit, I'm sceptical.
I'm a bit sceptical on that one as well, and I wonder whether that, we've got to bear in mind with anything we hear about BP now, that they do have Elliott with a 5% stake in the firm, and is this a case of someone planting a few news stories here and there just to try and basically give the board a bit of a kick and say you need to hurry things along and do what we're asking you to do, or at least make concrete progress towards that. I can't imagine BP being a takeover target, to be completely honest with you. I struggle to see who would actually, in the firm as a whole as it is, I struggle to see who would take it on. Parts of the firm, they want to get rid of the solar business. They want to wind down their wind power business, or the offshore wind at the very least. You can understand those being snapped up. But to be completely honest with you, we all know that BP has been a bit of a basket case and a bit of a mess over the last number of years, really. Would you be sat out there as an investor, whether that be private equity or another oil and gas firm, going, there's someone I want to buy and take on all their problems? That's a hard sell, I think.
Well, they did have an investor day, I think, fairly recently, and CEO has announced the company is signalling a reset towards oil and gas. They've called time on their US onshore wind portfolio in Lightsource, as well as its global offshore wind business through a new 50-50 joint venture with Japan's JERA. So they're looking to sell them. So that was the key takeaway.
Yeah.
There has been chatter, we talked about this, about a bid, but I can't see it on national security grounds anyway, particularly given how that we live in such uncertain geopolitical times.
Yeah.
I think the government might have the government might have some input into whether or not a foreign investor takes over BP. Some have suggested that they might do a shotgun marriage with Shell. I can certainly see Shell shareholders having a very dim view of that, notwithstanding any antitrust issues that they may encounter going forward. So I think BP needs to solve its problems by itself.
Yeah, that... Again, there's been a lot of chatter about that. Do do BP and Shell do some sort of tie-up? I can't imagine either side being overly keen to do that unless it's absolutely necessary. And to be honest, it's not. And as you say, it's going to be a case of BP having to get out of this. Well, it was a mess that they put themselves in, so it's probably only right that they have to get out of it on their own as well, really.
But I think unless they start to deliver some short-term benefits or a clear strategy, then I think we could see a change of CEO in the next 3 to 6 months, because I would imagine that Elliott's patience threshold is very, very low.
Well, I think their patience
as is most shareholders.
Yeah, and I think Elliott's patience is already wearing pretty thin, to be honest with you. I mean, this week I think they revised up their free cash flow target by 40-odd%. So clearly progress isn't sizable enough or quick enough for their liking at the minute.
Absolutely. So BP is on the 9th of April and Shell is on the 2nd of April. And we've already got a fair idea of the type of numbers that they've had are likely to publish because of the production targets that they issued earlier this month. And obviously oil prices are at the lower end of where we were, so there's going to be a tangible effect there as well. So not looking for anything significant there. Banks. It's a big week for banks.
It is a very big week.
They've done really well, notwithstanding obviously the volatility that we saw earlier this year when we saw a big sell-off in HSBC, largely on the back of the Trump-China tariff trade war story, and obviously HSBC do an awful lot of business in Greater China, and I think there was perhaps a feeling they may get hit by that. All three of them, Barclays, Lloyds, HSBC, all seen a fairly decent rebound. So really, I think the key question for me, setting HSBC to one side, and Barclays and Lloyds and NatWest, of course, almost forgetting NatWest, they've pretty much bounced back and recovered most of the losses that we saw in the early part of the sell-off that we've seen. So it's really about how do they see the outlook going forward?
Yeah, no, that is exactly right. And actually, NatWest are the pick of the bunch year to date, or at least they were when I looked preparing this earlier on this morning. Yeah, you're absolutely right. It is a case of how do they view the outlook. I think a lot of the declines that we saw in bank stocks, certainly at the start of April, were kind of the baby being thrown out with the bathwater, if you like, where market participants were just going, oh my God, these tariffs are so much worse than we expected. That's going to hit everyone very, very hard indeed. Clearly, clearly the stance has softened on that. The rate outlook is not looking anywhere near as dovish as it may have done when that tariff news was breaking. So yeah, I think things have become a little bit more constructive. There's a few sort of idiosyncratic factors at play, of course. There's questions around NatWest. Are they able to fully return to private ownership this year? HSBC, as you said, obviously the China story that's well known. And then, of course, Lloyd's with the whole Black Horse motor finance thing, which has gone a little bit quiet. So yeah, there are a few things to bear in mind on that front. On the whole, I have been pleasantly surprised, I would say, by the resilience of the UK banking sector. Well, by banking sector, I mean by the stocks, not the actual financial system itself.
I get it. I get it. I mean, basically, what we've seen is all the losses that we've seen in April are pretty much gone. We're back to where we ended March, and NatWest, the government stake in NatWest is now 2.99%. So, to all intents and purposes,
it is basically zero, isn't it?
It's basically there.
Yeah.
So really, they are completely now in charge of their own fortunes. And looking at the numbers, you can read all about it in my note. I'm not going to go into great detail, but I've written a big note on UK banks, and I will post that on my Substack at some point later this week. Because as I say, my week ahead is, it's a 2-pager all by itself, just for UK banks.
It's a very good novel, but it is a novel.
Yeah, it's very novel. But yeah, I mean, all those points you made, Black Horse Finance with Lloyd's, it's back above 7 after dipping to 60p. What was interesting that all the sell-offs that we saw in the banks bounced off their 200-day moving averages. So crayons work.
You know what? I'm going to have to raise this point again now, aren't I? But for those who didn't hear it the last time I made it, I don't mind moving averages. I actually quite rate, certainly the longer term moving average, things like the 200-day moving average. It's all this other nonsense around, people just drawing coloured lines for the sake of coloured lines that I am not a fan of. But I'll get back off my soapbox.
You and me need to have a chat. I'm going to put you in a class and try and convince you of the merits of trend lines, support and resistance, because there is value there.
I'm sure there is.
And I think you spent too much time at bloody business school.
As long as you don't tell people what you think MBA stands for, then we'll be all right.
Yeah, don't worry, I won't. And I think most people know what I think it stands for because I've never been shy in saying it. Certainly Ryan does.
Oh, God help us.
Anyway, I'm digressing ever so slightly. So obviously we've got UK banks. So obviously I think the outlook is going to be the key thing there. How do banks see the outlook against a backdrop of a much higher cost of living as we head into the second quarter of this year? Because it's going to affect their customers.
Yeah.
And ultimately, I think in terms of current accounts, loan demand, mortgage approvals, we've got that next week as well, mortgage approvals.
Yes.
But again, I don't think they're going to be particularly instructive. What I'm interested in is mortgage approvals after the stamp duty rise in April. Will they drop off really sharply?
Yeah, I was going to say it's March data, so you're probably going to, in a similar way to how we've got all these people front-running imports into the US, we've effectively got people front-running mortgages to try and complete those house purchases before the stamp duty changes. So yeah, that will be maybe one to just take with a bit of a pinch of salt.
We've got AstraZeneca's first quarter numbers on the 20th. I think I'm interested in that only in the context of the pharma industry more broadly and the Trump administration's approach to drugs prices, because that has affected the AstraZeneca share price. And I think the bigger question, around pharma is really, given with Robert F. Kennedy in charge of health in the US, what sort of tariffs or import duty will they place on drugs going into the US, and how badly will it affect companies like GSK, Haleon and AstraZeneca?
Yeah, and actually the other point on AstraZeneca, but also pharma more broadly, there were reports via Reuters sources earlier this week that were saying not only is the Trump administration looking at pharmaceutical tariffs, as they've long been talking about, there's also the potential for the Trump administration to look at drug pricing. And these sources were reporting that they want to bring US drug pricing in line with that seen on this side of the Atlantic. And actually what I thought was interesting was a few people within pharmaceutical firms have been quoted within this piece, and the general vibe was that would be more catastrophic to their businesses than if they slapped a load of tariffs on the sector. So you could be looking at potentially a sort of double whammy on that front.
Well, let's hope not. For their sake. Because, basically farmers are really good at revenue income earner. for
Yeah.
particularly the defensive side of the UK index. And obviously AstraZeneca, I think, is up there with HSBC as the biggest company on the FTSE 100. So what happens to it matters in the context of the UK blue chip.
Yeah, no, I fully agree. It is definitely one to watch. And it's not a case of us being able to go, well, that's in the US, we can sort of ignore it. There is actually a global impact, not just on the UK market.
Okay, we've got Associated British Foods. For those of you who don't know, they own Primark. So I think in terms of budget retailers, they're an interesting, I think, bellwether of the health of the UK economy in the same way that B&M European Retail was, which we talked about last week. Again, when they reported in January, it was on the back of a modest rebound in pre-Christmas spending, saw Primark sales grow by 2%. But what was interesting about that particular number was all the sales growth was in Europe and the US. UK and Ireland actually saw a decline.
Yes.
So, I'll be very interested to see the regional breakdown on that. The rest of their businesses, agriculture, sugar, and what have you, tea, Twinings tea. The business wasn't great. They saw big declines in sugar and agriculture of 6 and 5.1% respectively. Seen a big rebound since the start of the year in the ABF share price. So it'd be interesting to see whether or not that's sustainable. It certainly looks that way when you consider that a year ago it was at £27. It's been as low as £18, and it's now just around about £22 now. So interesting to see whether it can sustain the rebound that we've seen since those lows that we saw back in March.
Yes, indeed. And I think it's it's a real eclectic mix of stuff that they've got in terms of their portfolio of brands and businesses. But that regional split will be quite interesting and instructive, particularly if sales in the UK and Ireland have continued to struggle, that you then sort of start to ask, what does that mean for the economy more broadly, particularly given the, should we say, the end of the segment of the market that Primark sort of positioned themselves within.
Yeah. I was looking at their store rollout program in their growth markets in Europe and the US, and that's on track to contribute around 4% to total Primark sales growth. And though it's likely to be offset by weaker like-for-like sales in the UK, it could be that maybe UK and Ireland sales become a much less important part of the overall Primark sales story.
Yeah, potentially. Because they have been they have been the most pivotal part of it for quite some time. So if that does change, that's certainly something to keep an eye on.
Okay, I'm going to quickly talk about one of our favourite topics, or what should I say, one of our TikTok's favourite TikTok audience's favourite topics, and that's Travis Perkins. Shares fell to a 16-year low when they finally released their full-year numbers. They have rebounded somewhat since then. Let's recap those numbers for our audience. Revenues slipped to £4.6 billion. Operating profits fell 99% to £2 million from £161 million the previous year. The company recorded £139 million in respect of impairments across branches and the firm's Staircraft business, and the company fell to a loss after tax of £77 million. So they posted a cautious outlook. So we'll get to see how that pans out when they report later in the week. We could ask why Travis Perkins is suffering perhaps more than its peers like Kingfisher, Wix and what have you. But I think one of the key takeaways that I took from some of the comments on the comment board were their prices are too high and their customer service isn't great. Though the adjective for isn't great was slightly more salty.
Yes, I'm not sure we can repeat some of the adjectives, but I do thank those comments because they've given us incredible insight into the builders merchant sector that we would have had no idea about otherwise. Yeah, I think you've covered pretty much everything there is with that one. The only other point I would make, unless this one's passed me by, is they're still looking for a new CEO. Of course, Redfern had to step down due to ill health. So again, given the, ailing nature of the business, let's say, it will be interesting to see who they do end up appointing in that role, and also in due course what their turnaround plans are as well.
Yeah, it would be interesting to know, because at the moment I think they sold the Wix business. Why did they do that? Because the Wix business is doing very, very well, and the rest of the business has sort of been allowed to wither on the vine. Yeah, it makes absolutely no sense that the idea that the Travis Perkins business was being held back by the Wix business has proven to be slightly short-sighted. Anyway,
well, if anything, it was the opposite, I think.
Well, maybe Wix have got the better end of that particular deal.
Yes,
anyway,
most definitely.
Okay, big tech. Where should we start? We got Meta Platforms, Facebook. I don't really want to talk about them. They're in my bad books, and the less said about them, the better. Microsoft, Apple, and Amazon. All of which, well, at Microsoft and Amazon and Alphabet tonight, cloud business. For me, I think it's going to be important in the context of the cloud business in terms of growth. I think one of the key takeaways from the Microsoft numbers was that their Azure business saw a 21% increase in revenue in their most recent quarter, and they expect to see revenue growth of 32% in this current quarter, even though revenue was expected to be between 67.7 and 68.7, so slightly down from Q2.
Yeah. No, I think you're absolutely right. I think it is going to be a case of those cloud revenues. We know the extent to which they have been underpinning earnings for these firms, well, certainly Meta, Microsoft, and Amazon in recent quarters, and I think investors will naturally be looking for that to continue. I guess the other two things to focus on for all four of them is the issue of AI. As we were mentioning last week, a couple of quarters ago, we were kind of sat here going, all of this CapEx on AI research and development, when's it going to pay off? I think that question has only become more urgent since the emergence of DeepSeek at the back end of January, or the supposedly cheaper and better AI technology. Do you need such a huge degree of expenditure? The other thing on AI is, of course, Apple have been massively struggling with this Apple Intelligent product that they've been trying but failing to get off the ground for some months now. So wonder whether we get an update on that front. And the second is, of course, particularly for both Amazon and Apple, who report next Thursday, is the issue of tariffs and is the issue of trade. We've heard reports that Apple are looking to move production of iPhones for sale in the United States. That's being moved to India. Amazon, of course, well, we all know that a hell of a lot of Amazon goods have made in China stamped on the box. So it'd be interesting to see the degree to which they are being caught up in the whole sort of to and fro over tariffs, and any comments that they have, and also any potential guidance headwinds that causes to the guidance that they issue for coming quarters.
Yeah, I mean, Apple generally don't offer guidance. I think they stopped doing that post-COVID, didn't they? So I think one of the key things, you talked about it earlier, was obviously Apple and tariffs and China. One of the key things I took away from the first quarter numbers, and the first quarter numbers, it was a record revenue number. So there was no concern then. But again, of course, that was before Trump basically stamped his mark on the White House. But one of the things I did take away from those Q1 numbers was that services saw a big increase in revenue from 23.12 billion the same quarter last year to 26.3. So they now make up a quarter of revenue for Apple. So I think that's an interesting dynamic, particularly when you look at, say, for example, the sales of iPhones, the sales of Macs, the sales of iPads. And the only real weak spot was wearables, sort of the watch.
Apple Watch and things
Apple
like that.
Watch, which
and
I
the
think...
old glasses, the headset, that all went very quiet, didn't it, as well? And that seems to have flopped a little bit.
Well, that's interesting you say that, Michael, because Meta, obviously, they've got Reality Labs division.
Yes. Which
is obviously also AI, and they're looking to invest between $60 and $65 billion in their 4-year capex. More investment in AI and Reality Labs, and $5 billion loss in their Reality Labs division suggests that, again, they're spending all this money, but there's not really getting much of a return for it. But where they are making money, they're making absolutely bucket loads.
Yeah. And it sounds, slightly callous maybe to say it, but almost because they're making, bucket loads of money from ads and from cloud and whatever it may be in Apple with record revenues, you almost wonder whether the firms kind of go, well, we actually don't mind losing money on these slightly speculative R&D projects for quarters, if not years in a row, because they will have the belief that at some point this will pay dividends and it will become a product that everyone is desperate for. So I guess they're in a very fortunate position where, as long as the market and the investor appetite is still favourable, it's almost a case of, well, they have license to go and do that.
It's interesting to see that, looking at Apple's stock price, looking at Amazon's stock price, they're virtually a mirror image of the S&P, which you would expect them to be. What's interesting is that we've seen on Amazon 50-day cross below the 200-day moving average in what is known as a death cross. Now, I like moving averages. I'm a little bit sceptical about golden crosses and death crosses because ultimately it really is in the eye of the beholder. But what we've seen thus far in terms of the bounce in these tech stocks, it's been much more nuanced than, say, for example, like Netflix, which has completely reversed all of its losses and is making new record highs.
Yeah.
Which suggests to me the market is still very nervous about owning, or basically reacquiring after the losses that we've seen.
Yeah.
These particular companies.
Yeah. I also just wonder whether that, and I fully agree with everything you said there, I also just wonder whether it speaks to the point of how allocations have been shifting over the last kind of month, 6 weeks or so. Investors were massively overweight the US and they were massively overweight US tech. Have the developments that we've seen recently been a sort of wake up call to become much more sort of market weight those geographies and those sectors? And you're going to probably need a fresh impetus in order for people to sort of pile back into the Magnificent Seven in the nature that we saw in 2023 and 2024.
Yeah, I mean, the Meta's the same. We've seen virtually very little bounce in Meta. We've seen very little bounce in Apple. We've seen fairly little bounce in Amazon. I'm looking at Microsoft. Again, probably a bit more of a bounce in Microsoft, but even here, I think there is a nervousness about piling back in to this particular sector. So I certainly think the numbers that we see on the 30th of April, where we've got Meta and Microsoft, and on the 1st of May, Apple and Amazon, I think there'll be a good guide as to whether or not this, what I would call, we're in the eye of the storm, I think.
Yes.
When it comes to US tech. Be interesting to see which way that breaks.
Yeah, no, I would fully agree with that.
Okay, well, I'm pretty much sure we've managed to get in under an hour, Michael. So
we've done very well there. I think we owe ourselves a pat on the back.
I don't think we've missed anything. Actually, one thing I would say, because we didn't really cover it at the beginning, obviously gold has continued to make new record highs, which suggests to me that, we are still very much in the uncertainty window when it comes to where markets are likely to go to next. The dollar. I've read an awful lot of narrative this week about the fact that, perhaps the dollar decline has run its course. Maybe it has, maybe it hasn't. Euro dollar's popped above 114, moving to 115. I was reading somewhere that, I'm not going to mention his name, but he thinks that we've topped out in euro and we're going to head back towards 108.
Struggling with that.
I'm struggling with that a little bit. As you said last week, the market is not trading on yield differentials anymore. It's not trading on whether or not the ECB is going to cut more than the Federal Reserve. It's trading on a completely different dynamic, and that dynamic is a loss of faith in the US as the haven of last resort. That's not to say that it's not a haven. It's just that people's allocations to the US are probably going to be lighter than they would have perhaps been 1 or 2 years ago, and they're going to spread their risks slightly more evenly. Yeah. And that would suggest that perhaps I said it last week, I think we could be heading back to 120. For me, I think the key level on euro dollar is 112.50. If we hold above that, then I think there's potential for us to go quite a bit higher.
Yeah, no, and I'm actually glad that you've brought that point up, because this goes back to something I was saying yesterday. We're sat here and we discussed this briefly earlier on. Markets do appear to be trading in much more positive fashion this week, and it would appear that at least at the margin, some of this more conciliatory tone towards China has been received well, and clearly it's had and continues to have bullish implications in the near term. But I think when the dust settles a little bit more, it again just speaks to the frankly incoherent nature with which the White House continue to deal with things. I mean, ultimately, President Trump is seemingly negotiating with himself on China at the moment. And just, he's realized that things aren't going as well as he expected. So he might decide to cut tariffs to try and give everyone a little bit of relief. And I think the issue here is that we spoke a couple of weeks ago that one of the reasons why, as you said, this idea of haven of last resort and the credibility is being eroded is the volatile nature of policy making at the moment. And whether that policy is good or bad for the market, it is still being made in a very volatile and a very uncertain manner. And that, in my mind, will continue to take the shine off US assets when you're looking for a place to shelter from a prevailing storm that may be going on.
Yeah, and you've got China now calling Trump names.
Yeah, exactly.
So that's not, it's not totally conducive to a harmonious relationship. I mean, maybe this is for the consumption of their domestic audience, but I don't think it's likely to land very well in the White House. So, I think...
I was going to say, it also doesn't exactly scream, we need to make a trade deal right now. As much as Trump likes to go on the news wires and say, China are desperate for a deal. Well, listen to what they're saying. They don't seem that desperate, to be completely honest with you.
Exactly. Scott Besant, think he's done a fairly good job in calming things down? Maybe he's got through to the president and made him realise that perhaps belligerence needs to be toned down a bit?
Maybe. I think it's interesting how we're hearing more from Besant and less from Lutnick, and frankly nothing from Peter Navarro, who seems to have been locked in a cupboard somewhere.
Long may he stay there.
Well, precisely. And again, that might just suggest, in terms of you're putting some of the more hawkish voices to the back of the mind of market participants. Again, maybe that message has got through, but let's be honest, this is Trump. One Truth Social post, and we may as well just tear up everything we've just said.
Indeed. Okay, we're going to finish off with cable. We retested those peaks of last year, 134.5. If we can get through there, then I think there's certainly potential for us to move a lot higher. That's not to say that we can't dip back to 130 first, but ultimately, I think what we've seen in the cable so far, and that's not representative as a vote of confidence in the UK, it's just merely a consequence of the fact that I know there's an awful lot of cable short positions out there, and they've been squeezed out. And if we go through 134.5, you could see an awful lot of more of those short positions start to get squeezed even further.
Yeah. Absolutely.
Okie dokie. All right. Well, thank you very much once again, Michael. It's been an interesting chat. We got through a hell of a lot.
Indeed.
Next week, we're going to preview the Bank of England and obviously the Federal Reserve. And then I'm going to take a week off. But I'm sure we'll have plenty to talk about when I get back. But before then, thanks very much for your input. And I will speak to you same time, same place next week.
Indeed. Bye for now.
Cheers.